Hi there, my name is Thomas DeShooter. Today we're talking to Jay Balla of AIP Asset Management in Toronto. And what we're talking about is how to protect client portfolios from something like the Dow falling 1,000 points last week, the rise of interest rates in the US, the 10-year Treasury has hit 3.2%, and what to do about cannabis stocks. Is there any value left in that marketplace?
I think we can maybe just start with sort of a quick background. So, a lot of the SMA clients will notice that about, call it a few months ago, probably about 3 months ago, their equity exposure was predominantly through the KLD, the S&P, the Spider ETF, the Diamonds, which is the Dow ETF, and the XIU, which was the TSX ETF. And that's how we had equity exposure for all the SMA clients. About 3 months ago, we actually sold those positions off and we rolled it into a fund called the 9-point enhanced equity. And the reason we did that is the way that fund is built, they had built it for their high net worth clientele. And their high net worth investors said, look, if the market takes off and it doubles, and I'm good with a reasonable rate of return, I want to sort of track the exchange. But if there's a massive swing to the downside, I want my principal protected. And so that's the reason we flipped it over, because we looked at the markets and said, things are getting a bit frothy here. We don't want complete equity exposure. So if the market goes up, they'll still get some returns as it goes up. But as the market, were to crash and burn, their losses would be somewhat limited. At least that was in theory. And we actually got to battle test it, I guess, last week, which was a good thing. The Dow was down 4%. The fund was only down about 1.5 points. So it's working in a practical nature as well as the theoretical world. So we're happy about that. We think the portfolios are positioned very well for if there were to be a significant tick to the downside. I think we'd at least have somewhat limited losses as opposed to bury the full weight in the market. So we're relatively comfortable as we're positioned today.
Right. And that's John Wilson running that money, isn't it?
That's right.
Yeah. So, without getting too technical here for people, but my understanding of the way John does things is he kind of lays out some options contracts in order to protect on the downside. Is that accurate?
That is correct. So he uses a lot of put options and other derivatives to just sort of buy, I guess, for a better word, he buys insurance on the portfolio. So there's an obvious cost to that insurance. So that's why when the market goes up, he's obviously, he's up minus the insurance premium he's paying to protect it. And on the downside, he's getting that insurance premium. But obviously, it's not a zero loss. I mean, you're going to lose something, but you're just not going to lose as much as everybody else.
Right. I know he somewhat battle tested this back in '08 as well, and did well in protecting client money. So I'm familiar with what he's doing.
Right. And now then that's why we liked it, right? I mean, I think we're looking at the markets today and we're saying, look, at the end of the day, an investor can make their money back if they take a 10 to 15 to 20% loss. Like, let's say you have a complete black swan event and you're down 20. That's a battle you can fight. That's money you can recover over a period of time. Whereas you have full exposure to the equity markets and you're down 50, 60%, that's a very hard loss to recover from, right?
Mm-hmm. Yeah. Well, you're down 50%. You need to double your money just to get back to where you were. And, we know how hard
exactly.
it is.
I think people don't realize. Yeah. I mean, it might take you a good 5-6 years to double your money, right?
Yeah. Or longer, because you what tends to happen, what I've seen is that after a loss like that, people come back even more conservative. And so they're not even exposed to something that has the potential to double their money. So
it's like they take the loss, they actually crystallize that loss by selling their position, and then they hide under their desk for like the next 2 years and saying, I don't want to do this again, but it's the worst time to do it, right? And I think
the rule of 72, right? It takes, if you're getting a 2% return, it's going to take you 36 years to double your money. So
yeah, basically, right?
Right. Okay. And then now we also saw interest rates on the 10-year in the US hit 3.2, and we've fallen a little bit off of that, but some of the rumblings I'm hearing is that rates are going to be moving higher. How are you positioning fixed income in this environment?
Yeah, no, I mean, like our position of fixed income has been very similar all the way through. We've always said, look, this is a rising interest rate environment. We've always held shorter maturity, shorter duration bonds. So, all our bond exposures, less than 3 years. And our worst case with bonds is we're just going to hold it for the 3 years until it matures, regardless of what happens to the price. And we'll get our principal and our interest back and we'll move on, right?
Right. So you're not playing in the fixed income market. You're more or less just building a good, predictable outcome.
Exactly. Because, I mean, there's places to take risk and there's places not to take risk. And we always say, that's sort of, the way we've got it positioned now is, look, the bonds are your safety capital. That's if, the world comes to an end, you still have your bond money. Like whatever's allocated to bonds, whether you waited out a year or 2 years for maturity, you're getting your bond money in. Right. The equity hopefully is, you're getting a limited impact. And with the alternatives, hopefully that's your alpha generator, right? If the market kicks off, the hedge fund does great. I guess the hedge fund's more built for battle, right? Like it's meant for the ups and downs of the market. So we're relatively comfortable there.
Right. Well, it's not really correlated to the stock market as such, right?
Exactly. Or the bond market. I mean, I think it's got like a 0.1 correlation to both, right? And I think what's going to be interesting here is I think, even if the market were to collapse, I don't think the Feds can stop raising interest rates. And I don't think they're going to care. Like at the end of the day, their mandate is to limit inflation. And look, the market's crashing isn't going to change that. They're just going to keep ticking rates higher and higher. And look, they're not in the business of playing politics. They're not in the business of inflating the stock market. I think a lot of people are going to come to that reality soon where they go, wait a minute, the market's down 30%. Why are these guys aggressively raising rates? And the answer is it's their job. That's what they do. That's what they're mandated to do, right?
Yeah, I think Trump would like to make it a political issue. He seems to be throwing footballs or lobbing grenades these days at the Fed, but it seems like the Fed is held strong.
Well, no, I mean, the way it's designed is that a Fed chairman once appointed will outlive any president. So I think their terms are like 15 years. So it doesn't really matter. Like once they're in, I don't think the president can fire them. It's built not to be a political vehicle. And same thing with the central banker here, right?
Right. Last thing I wanted to touch on, Jay, is, I've seen Canopy Growth, which is, the ticker symbol is weed, go from, $2 a year and a half ago to $60 today on the TSX. Right. And, what sort of cautionary tales would you have for anybody out there that might want to just start going and throwing some parlays into the cannabis market?
Okay, I mean, let's start with the basics. I mean, look, this is a pure capital allocation play. So look, risk nothing more than 5% of your portfolio on it. Be super picky about which ones you pick and be ready for volatility, right? Like if your stock's down 30%, hang in there because, you already know what your contained risk is. Like, if you got $100,000 portfolio, you've gambled, and that's what it is. It's a gamble. You've gambled 5%, $5,000. If it goes to 2,000, don't worry about it. If it goes to 10,000, you may want to take some money off the table. But look, it's very high risk, right? I mean, half of these valuations don't actually make any sense, and they're going to have to grow into it. And so, this is going to be a nice long-term play, but it could work out incredibly well, right?
Right. I sort of look at it like the beginnings of the tech sector years and years and years ago, right? Where, people think, oh, wow, look at all the money I could have made on Apple. But, Apple started trading in the 80s.
Right.
But, we're 30 years down the road. Like you would have had to have bought Apple and owned it when it went to $150 and still owned it when it went back to 12.
That's right.
Right.
And this sector, I would always say is, the closest thing is probably the alcohol sector, right? It's like, imagine you had bought an alcohol stock back in the 30s when they legalized it. So, I mean, unlike Apple and everything else, I mean, this is a growth industry. It's going to grow by multiples for the next 30 years, right? It is going to be a gigantic industry. But also keep in mind that probably 90% of the stocks that were around in the 1930s that did alcohol either don't exist anymore or were acquired by a larger vendor, right?
Yeah. So we're going to see a lot of shifting, moving going on in that sector.
Yeah, but you're going to see lots of ups and downs, I think. But I mean, and again, as long as you have a contained bet, I mean, it should be okay, right?
Yeah, here's what I'll say about that. I went and saw First Man last night. The Apollo mission with Neil Armstrong landing on the moon, and all I can think about is buckle up.